The accounting equation simply states that the resources a business owns, which we refer as the assets, at any given point, they must be equal to capital and liability. The resources a business owns, any resource that a business owns, we normally refer to it as an asset. That asset, or the total value of the assets that a business owns, they must be equal to the value of capital and the liabilities. Capital, it is the amount of money the owners or the owner contributed towards that business. Towards starting the business, the owner or the owners must actually contribute the capital. They must pull the resources together to start the business. So those resources that they have pulled together with the aim of starting the business is what we refer as the capital. Liabilities are simply the business debts, the business obligations. In the course of running the business, you can acquire things on credit or you can borrow some resources. Those resources that you borrow, then it simply means that you owe somebody a certain amount of money. So the total amount of money that you owe the outsiders is what we call the liabilities. You can buy goods on credit, supplier becomes now a liability to you. You can borrow a loan from the bank, that loan is a liability because you need to pay it back at a later date. So all those obligations that the business has towards the outsiders, we normally refer to them as liabilities. The capital, the resources that the owner or the owners have contributed towards the business. So in simple terms, now we can actually summarize this equation as follows. The total value of assets the business owns, they are normally financed using two ways. Either they are financed using the capital or they are financed by liabilities. For you to acquire an asset, either you buy it using your money or you buy it on credit. When you buy it using your money, you have used your capital. When you buy on credit, you have created a liability. So the total value of assets, when we pull them together, they must be equal to capital and liabilities. They are financed by the owner's equity, which is capital, or they are financed through liabilities. And I'm sure you went ahead to discuss about the assets, which I've said they are the resources that are owned by the business. Anything that you can say this is ours in the business, it is your asset. And these resources are assets. They can either be fixed assets. Fixed assets are also referred as the non-current assets. These are the resources the business will own and use them for more than one financial year. A financial year normally runs for 12 months. So those resources that you are going to acquire as a business, and you are going to use them for more than a financial year. You are going to use in the financial year 1. When you go to the financial year 2, they are still there, you continue using them. Financial year 3, some of them are still there, you are continuing using them. So those resources that will remain in the business for a considerable long period of time, beyond one financial year, we normally refer to them as fixed or non-current assets. They include things like the motor vehicles, the land and buildings, the machinery, the equipment, the computers, furniture and fittings. All those are the resources we refer as the non-current assets. Actually, from the business perspective, we don't buy them with the aim of selling. We buy them so that they can assist in the smooth running of the business. So like, for example, a motor vehicle, you buy it for the purpose of delivering goods to the customers, delivering goods from the suppliers and such kind of things. You have the building where your business is actually situated. Instead of paying rent, that business is used to run or to provide shelter for your business operations. You have the furnitures, the tables, and all that in the business. They are just used in the smooth running of the business. In short, fixed assets, they are acquired with no intention of selling them. You normally acquire them with no intention of selling them to make profit. They are not part of the goods that you buy and sell. They are simply the goods or the items that you buy to assist in the smooth running of the business. So they are going to be there for a considerable long period of time. They are known as the non-current assets. Then number two, we have got those resources referred as the current assets. The current assets are the resources the business will own for a short period of time, not beyond a financial year. Those resources that you can have in your business for a short period of time, they are known as current assets. They include things like inventory. Inventory now, they are goods that you buy so that you can sell to make profit. They are the items that you trade on. They are normally current assets because you are going to acquire them within a very short period of time. You have sold them. The cash in hand, you have the cash after a short period of time, you have spent that cash. The cash at bank, the same case. The debtors are actually the credit customers. You sell goods on credit to a customer, that customer becomes your debtor. That customer owes you. Therefore, that amount that the customer owes you is your money. So it is your resource. So it is your asset. So these are the assets that are not going to be in the business for a long period of time. They are going to be there for a short period of time and you don't have them anymore. Then capital, I've said, it is the amount of money that was raised by the owner or the owners to start the business and run the business. Then it is also known as the owner's equity. Then we have the liabilities. For the liabilities, they are also classified into two. We have those we call long-term liabilities. We have those we call the short-term, or they are also referred as the current liabilities. They are simply the business obligations, what you need to pay. Therefore, when we say that a liability is a long-term liability, this simply means that it is that business debt that we are going to repay after a long period of time. Yes, it is a debt, but that debt is payable or it is repayable after a long period of time, e.g. the bank loan. You can go and acquire a 5-year loan, meaning that you are going to clear that loan after 5 years. You are going to have things like the bonds and all that. Those financial instruments that you can raise money from and you pay after a long period of time, they are known as the long-term liabilities. Those obligations that are going to be payable for a considerable long period of time beyond 1 financial year. Then there are short-term liabilities, and those liabilities or debts that you need to pay within short period of time. You acquire a debt within a short period of time, not more than a financial year, to clear them. And a good example here is the creditors. The creditors is simply your supplier or your suppliers. You acquire goods or credit from them, they become your creditors. You need to pay them within a short period of time. You also have things like the bank overdraft. The bank overdraft, when you have over withdrawn your account becomes negative. You need to pay that overdraft within a short period of time and other items that you know here. So these are simply debts, yes, but they are payable within a short period of time. These are those debts that we are going to pay after a long period of time. They are known as the long-term or non-current liabilities. So having understood that, then we can now proceed and see how do we record transactions in the ledger accounts. When we are doing the accounting principles and concepts, there's one concept we talked about, which is known as the dual aspect. also known as the double entry. The dual aspect or the double entry concept. So this concept simply states that when we are recording books, transactions in the books of accounts, we must always ensure that for every debit entry, there must be a corresponding credit entry. Meaning that every transaction that happens in the business, it has got two effects. It has two effects. Therefore, it will affect two accounts. And today, I want us to see how the transactions affect the accounts in two ways. How do we record transactions in the ledger accounts using or by observing the dual aspect concept? That is actually where we are going to learn today. And the moment you have a very good understanding in this area, the subsequent topics will become very easy for you to be able to understand. They will be very easy for you to be able to understand. So, in a nutshell, the dual aspect or double entry concept, it is considered to be the life and blood of accounting. It is raised a very firm foundation on how accounting transactions are going to be posted, even on the other books. But as we start, have it in your mind that in any business transaction, a business transaction is an activity in the business that is involving money. Either it is buying goods, selling goods, paying a supplier, all that. So long as there's money that is involved, we call it a business transaction. In any of those business transactions, we must have two accounts that are affected. And these two accounts here, we normally refer to them as ledger accounts. So we have the ledger, and we have what we call the ledger accounts. Let me explain the meaning of the two. A ledger is a book. A ledger is simply a book. This is a book. Being told here, this Zoom has not been updated. It might shut down after 10 minutes from now. So I want you to do this. If it shuts down, you log in immediately, kindly. And sorry for that inconvenience. I know the college is working on it. The moment it goes off, you log in immediately using the same link. A ledger is a book, the same way you have your book. And in that book, we are now going to have what we call the ledger accounts. The book, every page of that book is a ledger account. So these ledgers are normally three. They are normally categorized into three. We have got a ledger book we call the sales ledger. This is a book we are referring as the sales ledger. What does it record? This sales ledger, when you sell goods on credit to your customers, those customers to whom you have sold goods on credit, they become your debtors. So every debtor to whom you have sold the goods will have an account in this sales ledger. So a sales ledger book, it is a book that contains the ledger accounts or the accounts of the credit customers. So it contains the ledger accounts for the debtors. All the debtors. Anytime you sell goods to a person on credit, you go and record it down in the sales ledger. Every time you sell goods to another one, you record it to that particular ledger. So every customer would have his or her own account or page in that particular ledger book. So like, for example, page 1, you sold goods to person A. So page 1 is A's account. You sold goods to B. You are going to have an account for B. So in the whole year, all those customers to whom you have sold goods on credit will have the account in the sales ledger. So note this, the sales ledger contains ledger accounts for the credit customers or debtors only. you will never find another account or another activity that is not related with the debtors or credit customers. Debtors or credit customers only are going to have the accounts in this sales ledger. When you sell to them, you open account. When they pay, you subtract from that account. So you are going to have these ledger accounts in this particular book only. Only the debtors are going to be found in the sales ledger. Then number 2 is what we call the purchases ledger. The purchases ledger. By purchases ledger here we mean it is a book that records the credit purchases. It records transactions relating to credit purchases. And when you buy goods on credit, that supplier from whom you have bought goods on credit becomes your creditor. You buy stock from ABC, then ABC is your creditor. You are going to have it here. So it has the accounts for the creditors only. The difference between creditors and debtors is one. Debtors are your customers. You sold goods to them on credit. So those debtors, they owe the business some amount of money. But the creditors, we bought goods on credit from them. So it is the business that owes them. So when time you buy goods on credit from a particular supplier, that supplier becomes your creditor. And therefore, you are going to record that one in a ledger book we call the purchases ledger. So if I take the purchases ledger, the ledger accounts or the accounts I'm going to find there, it is purely for the credit suppliers. Nothing else. I cannot find customers there. I cannot find items that I bought on cash. I will only find the items that I bought on credit. So anything that I bought on credit, its account is going to be recorded in the purchases ledger. So I'm going to find the name of that particular supplier there. The sales ledger, it contains the name of the credit customers known as the debtors, nothing else. So page 1 is for customer A, page 2 is for customer B, like that, like that. So when I want to increase the amount of money that that particular customer owes the business, I just go to that particular page. So every credit customer has his or her own account. The same case applies here. Every supplier has his or her own account. An account is only the page. That page is for customer A or supplier A. That is it. Lastly, number 3, we have got what we call the general. General ledger. The general ledger, it now records all the others. That's why it is known as the general. Apart from the debtors and creditors. Debtors and the creditors, they have their own ledger books. But now, if a transaction does not involve a debtor or a supplier, then it goes to the third ledger book we call the general ledger. All the other items, all the other accounts are going to be maintained in the general ledger. They include capital account, expenses account. You have the assets apart from the debtor. Remember, debtor is a current asset. All the other assets apart from debtors, be it furniture account, motor vehicle account, cash account, they are going to be found in the general ledger. All the other liabilities apart from the creditors, they are also going to be found in the general ledger. So it carries the others now, the general ledger. When now it comes to the ledger account, remember we have said a ledger account is a page. So it is not an ordinary book. A ledger is not an ordinary book like maybe the square rule or the single rule. It has its own unique format. You'll find that every page of the ledger book, it is going to have 2 sides. We have the side we call the debit, and we have another side we call the credit. It will have 2 sides. Then in between there, two lines separating. Then on the debit side, we must have a column for the date, details, amount. Here we also have the date, the details, amount. So that is how your account will be, or the page. Every page of the ledger will have this format. Will have this format. It will have two sides. The left-hand side, we call it the debit, and we are going to abbreviate it as the DI. This one is known as the credit. We are going to abbreviate it as the CI. So that is a page of the ledger, and that page is now the ledger account. That is the ledger account. That is the ledger account. So when we say that every transaction must be recorded in an account, this is how an account looks like. We have the debit side and the credit side. The debit side and the credit side. The credit is the right-hand side. The debit is the left-hand side. They normally record transactions in a particular way. Like, for example, assets, they have their own way of recording transaction in the assets account. The liabilities, we are going to look at them. The capital, and so on and so forth. We also have the expenses. We also have the transactions involving revenues, and so on and so forth. So our discussion today now is, how do we record transactions in ledger accounts? How do we record transactions in ledger accounts? That is where our discussion will actually revolve. So I want this one to shut down, then we log in, we continue. It's almost shutting down. Be ready to log in again.